Hi, this is Mike Larson from Money and Markets TV. Most of the time, investment analysis is extremely complicated. You not only have to understand every number on the balance sheet, but also the competitive environment and the day-to-day economic figures that could affect your investment. But sometimes it's much easier. Sometimes it's as simple as following the money, and this is one of those times. Just look at the balance sheet of the European Central Bank over the past couple years. It has more than doubled to nearly 2.7 trillion euros. And just this week, European policymakers signaled that the expansion is going to continue. In fact, the ECB doled out another 530 billion euros in cheap 3-year loans on top of the 489 billion euros it lent in its December long-term refinancing operation. 800 European banks lined up for this virtually free cash, up from 523 during the last go-round. And this is from a central bank that claims it's not even printing money. Meanwhile, the Bank of Japan and the Bank of England are flooding their markets with newly printed cash. And we can count on more of the same from the Federal Reserve, at least for the time being. That's because Ben Bernanke told Congress that the Fed is going to continue its ultra-accommodative monetary policy as long as unemployment remains high and inflation remains in check, or at least as far as the Fed considers it. So it's a good bet that the 218% explosion in the Fed's balance sheet is just the beginning. Or in other words, forget Alan Greenspan and his interest rate cutting campaign that helped fuel the tech bubble. Forget the massive dose of stimulus that fueled the housing bubble. And forget the cheap money that helped propel crude oil to $147 a barrel in 2008. You ain't seen nothing yet. Of course, all this newly printed money from central banks around the world has to go somewhere. And it's not hard to see where it's going. Why do you think virtually every asset class, from stocks to commodities to treasury prices, are being reinflated? In this kind of a market environment, when investors are throwing money at every high-risk investment they can find, I recommend a simple strategy. Invest in select stocks, sectors, or asset classes that will get a turbo boost from cheap money, but they can also hold their own when the sugar high wears off. Also, maintain hedges for the moment when the central banks turn off the taps. The last couple of times that happened, at the end of QE1 and QE2, the market collapsed in a matter of weeks. Finally, remember that this kind of policy making always ends in tears. The tech bust, the housing bust, the Great Recession, partially triggered by the explosion in oil and other commodity prices fueled by cheap money. I have zero doubt that we're going to see this most recent spending spree blow up in our faces too. It's just a question of when. So be sure to have an exit strategy in place and ready to implement. I'm Mike Larson for Money and Markets TV. Thanks for watching.